I'm Mark Kagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Pick and choose your own best-of-breed insurtech and data providers with Advantage Go's ecosystem. This episode is a very special one because, thanks to one of my guests, we're going to hear from somebody who I assumed I'd missed my chance of getting to appear on this podcast. Let me explain. Tony Ursano of Insurance Advisory Partners is someone I have interviewed many times over the past 20 years. In fact, I first met Tony when he was working at Willis during the 13-year reign of our second guest. Tony has recently executed quite a coup. That's because he's managed to convince industry legend and former Willis CEO Joe Plumeri to come and work with him at Insurance Advisory Partners. I'll let Joe and Tony do the talking, but I'll just say that you're in for a treat. Many of us in the insurance industry, particularly when we get to a certain age, tend to get nostalgic about an unspecified past era when there were so many more strong characters working in the sector than there are now. And then we complain that these days things aren't quite the same. Well, Joe Plumeri is exactly the kind of person that people my age tend to think of when they make that complaint. Of course, Joe is a senior executive with a glittering multi-decade career spanning a broad spectrum of financial services. But he's also a complete original and a natural speaker and great motivator. One of his strongest skills is the ability to express often very complex ideas in simple terms that large numbers of people can quickly comprehend and get behind. He's always original and he's always direct. There are no grey areas. This discussion examines the prospects for M&A and consolidation all the way through the insurance value chain, from carriers of all sizes and specialisms to mega brokers, MGAs and even hybrid carriers. You'll leave this discussion incredibly well informed, but there'll be a little bit extra. You'll have met an industry legend and heard his unique perspective along the way. Enjoy the podcast. Tony and Joe, welcome to the Voice of Insurance. Well, Tony, welcome back. And Joe, big welcome to the Voice of Insurance.
Thank you, Mark. It's nice to be here after 13 years.
Wow.
To be exact, almost to the day.
Well, Tony and Joe, you've spent your whole lives very close to insurance-focused investors, guiding them and advising them. How would you sum up the mood of insurance-focused investors today?
Well, I'll kick off and Joe can correct me as he does, but I would say that investors appear to be cautiously optimistic. On the one hand, consolidation is continuing to proceed as expected, and we're still in a market where people are able to get reasonable returns on the capital that they're employing in the business. But there are signs that, as everybody's talking about, there are signs that the market is starting to soften a bit. And more importantly, I think there are very clear signs that the premise that the world is becoming a riskier place is playing out in stereo. It probably only takes one or two incremental, either large events or black swan events that we're not expecting to remind people of just how much volatility can be associated with the industry and just how important a role the industry plays in absorbing that volatility. And that changes everything. On the one hand, it creates very meaningful losses for the industry. On the other hand, it could result in pricing getting better. So I think people are cautiously optimistic and trying to understand when they think about what's happening in the world of social inflation, when they think about what's happening with climate change, when they think about the geopolitical environment, what does that all mean at the end of the day for the returns that the industry can deliver to its shareholders over a sustained period of time?
I suppose it's good for the insurance product, but it's not always going to be good for the bottom line all the time. It's always nice when you have a loss to say, well, it's the best sales agent we could ever have, but at the same time, you still have to pay it. How do you see it, Joe, when you're out talking to people?
I think it's a wonderful double-edged sword. On the one hand, you're always going to have degrees of uncertainty, degrees of black swans, degrees of social inflation, degrees of new types of risks. And the world is becoming riskier and more uncertain and more exciting from the point of view that you don't know where it's coming from, more than ever before. But when you look to see what industry can protect people against all of that, there's only one, and that's insurance. So if I'm an investor and I'm looking at investing over a long term, which is the only way I think you should invest, and you're looking at sound companies with the right capital structure, with the right capacity, then I would rather invest in an insurance company that I understand that's going to be in the thick of things, can overcome all of the grinds, if you will, and the ups and downs of all of the things that now are at risk in the world, because the only place you can go to make sure that risk is mitigated is with an insurance company, and one who withstands all of the ups and downs of that. And certainly we're in the ups of that now. And I'm not sure there's ever going to be a down of it. There used to be a time when the black swan spiked and the hurricane spiked and all that stuff. But right now, a hurricane is replaced by something else, that's replaced by something else, that's replaced by something else. So I think it's a norm. And those companies that have the right capital structure, the right capacity to withstand all of that have to be a good investment from a long-term point of view. I had been, still am, the biggest cheerleader for the insurance industry, because without insurance, nothing works, nothing. And I think that the industry had a PR problem 13 years ago when I left it. I still think it has a PR problem.
I suppose, yes, we've come through relatively unscathed the hurricane season, but at the same time, at the beginning of the year, we started off with a $40 billion wildfire that we would not have contemplated even 15 years ago. It just wouldn't have been on our radar at all.
No, I think that when you look at insurance and you look at investing as a catastrophe or any kind of incident, the first responders show up first. The first responders put out the catastrophe, and the second responders, which is the insurance industry, rebuilds it. That's the way it works. And there's a lot of attention to the first responders, which there should be, to be able to put out whatever the cat is. But the second responders, which is the insurance industry, rebuilds it, and nobody talks about that. Yeah. Otherwise, there would simply be the result of the fire, the result of the disaster, or the result of whatever happened, sit there without the rebuilding taking place. And if you believe that, which I do, and not getting enough attention, then the rebuilding part is when, from an investor point of view, you start to reap the rewards of your patience for investing in a company that has the capital to be the second responder, which it should. And in a lot of cases, it's not even the second responder, it's the first responder, because you don't need a first responder for a lot of claims. You just need a claims adjuster, and they're the first responder.
Yeah.
So it's really cool. And I don't think anybody thinks about it that way. I can do hours of that, as you know.
I suppose, but we've got to get back to the day job with Tony and you. Tony, you'd mentioned about consolidation. You said consolidation, you were expecting it. Obviously, we've had 3 deals come pretty quickly, like London buses, perhaps. We had Sompo Aspen and then Skyward Apollo. And then just today, we've had the announcement of Radian Inigo. Do you think the starting pistol has been fired on this because of the way market conditions are, or just that some of these are just timing issues, that some of these companies probably were going to need a new owner around this sort of time?
Well, I mean, the answer is yes. So the theme that I've been preaching is that in this industry, the strong continue to get stronger and the weak continue to get weaker. You combine that dynamic with the fact that a lot of businesses continue to be private equity owned, like Inigo, for example, and the need for scale and geographic diversification and the ability to invest in technology and all of those things. To me, it's a continuation of a theme. It's been a constant pace of consolidation over a long period of time. I think we're seeing it accelerate a bit as the market begins to soften and as a number of these private equity investments mature and are ripe for a liquidity event. And I think we're seeing, more and more power concentrated in fewer and fewer carriers over time. So I'm not at all surprised. There's going to be, without a doubt, more to come, and probably more to come in the near term. And there may be a little bit of an increase in frequency, but I just view it as a continuation of a theme that will continue over the next 5 years.
Yeah. That's on the carrier side, but on the broker side, again, obviously huge private equity interest. We've seen some deals, and I think probably the last time we spoke was about 2 years ago. And you mentioned there was obviously a huge amount of private equity investment tied up in brokers. How much further have we got to go on that to reach that kind of end game that we were probably pointing to about 2 years ago? Time has passed now. All of those businesses are now 2 years older than they were last time we spoke. What's your view now? What are the most likely scenarios? And some of those businesses, of course, are getting to the point where they might be looking to float on public markets.
Yeah, well, Joe will have a very good perspective on this, obviously, but we now would say of the 40 plus private equity owned distribution businesses that exist out there of scale, it's probably $400 billion of enterprise value. And as a number of these companies get into the billion and a half dollars of EBITDA, the idea of a private equity to private equity trade becomes more complicated and on the margin less likely. And so I think what we're seeing is we're seeing people thinking carefully about whether they should tap the public markets. While multiples are off a bit, they're still pretty attractive in the public markets. We're also seeing, a number of these companies being absorbed by strategic acquirers. We've seen what Brown & Brown has done. We've seen what Gallagher has done. We've seen what Aon has done. We've seen what Marsh has done with McGriff, et cetera. And so that will continue. I think there's a little bit of an arms race in terms of scale in the brokerage and the MGA world as well. And so they're great businesses. And Joe Van Willis for 13 years, and he knows it better than anybody, but they're great businesses that attract a lot of private equity interest, but also that create growth for larger strategic buyers who are not just trying to grow organically, but are trying to grow through acquisition as well. And I turn it over to Joe for some thoughts on this.
If you look back, a lot of the brokers that existed when I ran Willis don't exist anymore. And there's a huge consolidation with brokers, agencies, brokers, whatever the case may be. And I think that that's always going to continue as long as the industry does not grow organically. I think that what's great about the insurance industry is that everybody has to own insurance. The bad thing is that they already own it, which means that the organic growth, I remember when I got to Willis, I asked if there was a client relationship management system where you build pipelines for new business, for new clients. And there wasn't. So it wasn't an industry that went after new clients. It was one that basically held on to what they had. And as a result, did not grow a lot organically. There was a lot of necessity to wait for hard and soft markets. I never understood why that mattered. It's like in a brokerage business in terms of investing in the stock market, there's a bull market, a bear market. And what difference does it make? You got people who need to invest and need to do so from a needs point of view. So I think that until there is a strong ability for brokers to grow organically, to come up with new innovation, new products, to be able to tempt clients away from others so that they can grow organically, there's always going to be this merger and acquisition phenomenon that exists with brokers all of the time. And then you have the issue of a lot of the smaller brokers or agencies that have been around a long time, and the families simply want to sell. So because of those two phenomenon, I think there's always going to be this yen for a merge, an acquisition, a buy, to be able to grow your business. You either grow organically or you go buy somebody. And if you look at some of the behemoths that have grown or ones that didn't even exist and all of a sudden are around, and where did they come from? They come from buying people for the reasons that I just mentioned.
On some of those very large billion plus brokers that probably need a new owner in the next few years, what's most likely out of that big three, big four, probably now these days, the big three, big four are already quite busy, occupy themselves with some quite big strategic deals already. Do you think they've got the capacity to take on more if they could do? Certainly around that time of the late 90s, that Pat Ryan showed that you could take on probably almost what many people would assume would be almost too many deals almost at once, but he managed to put it off eventually. Do you think we're going to get into that kind of situation, a bit like reminiscent of the late 90s when we had Marsh and Aon really, really going at it to build that global brokerage network that they managed to create? Are we in that kind of similar sort of phase, or do you think we will more like to see IPOs and other alternatives?
I think we're going to see both. I think we're going to see some select situations where large pools of capital, whether it's sovereign wealth or pension funds or private equity consortia, continue to find opportunities, even with some of the larger guys who are now gravitating up there into 30, $40 billion of enterprise value. I think we'll probably see some reverse mergers into some of the mid-sized brokers over time. I think we're going to see the large strategics who have been getting larger and larger through very successfully finding acquisition opportunities and integrating them artfully. I think we're going to continue to see that happen. And I think we'll see some IPOs without a doubt. So it's hard to generalize because each situation is so specific around the circumstances that surround it. But all of those avenues are avenues and tools in the toolkit that are going to be used to provide liquidity that needs to be provided and to provide the capital that people are going to want to continue to grow through acquisitions as well.
And what about the outlook for valuations? Obviously, we got up to a very big high, then interest rates rose. Obviously, central banks are now looking to ease, but we'll see what the real interest rates in the bond markets are doing. They seem to be still pretty up there in certainly US and UK bond markets. Has that affected broker valuations? Are they coming down to a more realistic level where deals are more likely to be able to get across the line?
I'd say, look, there's a marginal amount of pressure on valuations. Some of the public multiples have come off a bit. And this phenomena of, as you get larger and larger, there are fewer and fewer potential suitors or buyers or investors. And so, on the margin, that's put a little bit of pressure. But as Joe knows better than anybody, what a great business. The renewal revenue, the high margins, the lack of capital intensity, all of the attributes that has attracted all of this capital into this sector still stand. And when you look at the brokers, they're trading at 2+ times the earnings multiple that their brethren carriers are trading at. And that hasn't changed. So I don't know, Joe, if you have a perspective on
that business. And as you know, I ran a life insurance company. I ran an investment bank and then obviously an insurance broker. And the fact that you have predictable and recurring streams of income makes them very attractive. Now, maybe the multiple may not be 20 times EBITDA, or it may be 18 times EBITDA. As Tony said, it might have gotten a little bit softer, but those are pretty robust multiples. And the reason is because of the predictability and the recurability of the streams of income. So they make them very attractive, and that's never going to stop. That's never going to go away. And I think that they weren't that high when I was running Willis, but people caught on that they're very attractive when you look at the streams of income like that. And that those companies that can take the predictability and recurability and you can get high margins out of them because you run a business very well, or you can make acquisitions and be able to integrate them well, both from a cost point of view and from a synergy point of view. These are very, very attractive, valuable businesses. And I don't think that's ever going to go away.
What about if you were looking to break into the US retail market? This is a notoriously difficult thing to do. How would you go about it, Joe, if you were giving advice to anyone who was out there trying to do that, out from the international world?
There are a lot of agents or brokers. They represent clients and place business in the markets, and there's thousands of them. I mean, literally thousands of them. Sometimes there's 1, 2, 5, 6, and other times there's bigger ones. But in all the cases, they've been around a long time, Mark. And so if you said to me, how would you go about it? I would go about it by appreciating and understanding that these businesses are family-owned businesses for a long time. And that if you want to acquire them, acquire their business, but don't allow the legacy to go away. Yeah. I would say to them, keep your legacy, keep your name, keep what you stand for in the community. That should never go away. Become a part of what we're trying to do. I can help you build your business even more. I can give you the systems that you may not have now to help you build your business even more. But the legacy, the people, the relationship with the community, the family orientation, I want you to keep all of that. I never want that to go away. And so from an agent's point of view or a broker's point of view, they say, geez, this is pretty good. I get to continue with my business the way it was, with my clients, with my employees, with the relationships I have in the community. and I get to reap some of the rewards and take some money off the table, but I still get to keep my business and done the same way and even more enhanced because I got more resources and better systems to do that. That would be the pitch and the conversation that I would have with everybody. So it's a win-win for them. Rather than to sweep in and say, I'm going to buy your business and I'm going to change it completely, does not work.
Tony, what would you add to that? Would you go about it that way? Obviously, that's a model that has been followed.
It's a model that's obviously it's been followed and it's successfully been executed and created immense value for a lot of investors over a long period and individuals, management teams for a long period of time. And I think it's an excellent alternative. The one thing that would be on my mind is that is there going to be an arms race as businesses now scale to $100 billion in market cap as they are? And if I knew that I had actually the need to be truly global and not being present in North America was not a long-term option, then it becomes a question of how big a hurry are you in? Because to build it out the way a lot of people built it out through rolling up a lot of businesses over time, it takes time. And so if I were in a hurry, then I would take an approach where, look, if I pay an extra multiple or two over a 5 or 10 year period, it's really not going to matter because it's such a core part of my overall strategy. And there's a lot of synergy that can be driven from it. So I think both alternatives are viable and some work better in certain circumstances than other. But I think we'll see both strategies pursued.
We're seeing a more competitive global insurance market generally, and the news from Monte Carlo, should we say. We've had a spectacular period of fast growth in the MGA space and the hybrid carrier space. And obviously, we're seeing that consolidation of the carriers and in brokers. Do you think we'll see a parallel period? Because we've had this great flowering of so many hybrid carriers and lots of MGAs. Do you think we'll get to a point where we'll be seeing some consolidation amongst those players? Would that be logical as well, Tony?
I think it's absolutely logical. And the migration of underwriting talent out of the carriers into the MGAs, the new mechanisms for alignment between the MGAs and the carriers is creating a whole industry of highly specialized and excellent underwriting organizations. But the proliferation of this it will not be the case that every one of them will be successful in their underwriting endeavors. And it's only going to take one or two to burn a carrier to take a little bit of the balloon off the rose and cause people to be a little more cautious. And the same is true, and perhaps in a more magnified way with the hybrid carriers, where the leverage that they employ, premiums to surplus, the reliance that they have on reinsurance recoverables to write the business, it doesn't take a lot to create pressure on those business models. And so I think we're going to see a bifurcation of winners and losers in both the MGA and the hybrid carrier space over time. And there'll be plenty that are highly successful, and there are likely to be a few that aren't.
What often happens around this time as well, that you have carriers buying some of their favorite MGAs, an MGA they've been backing for a long time, and saying, well, actually, we want to bring them in-house if we can. Do you, again, see that kind of thing happening more?
Sporadically. The issue there is that MGAs are businesses without capital, and therefore purchase price equals goodwill. Goodwill dilutes tangible book value, and the carriers are so sensitive to their growth in tangible book value. Many of them are so sensitive to that growth in tangible book value that they really can't afford to actually buy the MGAs. We're seeing more carriers interested in strategic investments where they don't have to consolidate from an accounting perspective, but they create these strategic relationships where they provide capacity, but they also get some of the upside through an investment in MGA. And there are a handful of carriers who are indifferent about the tangible book value dilution, but they're few and far between.
It's a bit like another way of doing this bifurcation, which we saw with the Fidelis Partnership and the Fidelis Insurance Group. We've seen one similar deal with AmTrust actually announced very recently. But 2 years ago, we were talking about this saying, I would have asked you, do you think this is going to be firing the starting pistol? A lot of people looking at this and thinking to do something similar. Would you say that looking back now, would say, well, this was probably just a special situation, or those are a series of special situations that hasn't really been something that's become a trend or is likely to continue to become a trend? Or what would you say? Would you have another view?
I think that transaction structure is being thought about more regularly as one of the alternatives. And when you can pull it off, as AmTrust just did or as Fidelis did, and you can capitalize an MGA at those multiples and bifurcate the carrier, 1+1 does often equal more than 2. We sold a company called GeoVera, which was owned by a private equity firm, FlexPoint Forward, and we bifurcated the carrier and the MGA. We sold Velocity, and we bifurcated the carrier and the MGA. And in each of those circumstances, you create more value through that mechanism. We just saw SageSure buy a Florida business, bifurcating the carrier and the MGA. So it's being used probably more than people necessarily think about. And it works in certain situations and it doesn't in others. But when it works well.
I suppose it's like we've got a new tool in the toolkit that hadn't necessarily occurred to people that was something you could do before, and that's been shown it can be done and it can work. So it's there. It's always another option for any executive who's sitting at a carrier.
I think that's well said.
Obviously, you've just done a deal in InsurTech, and you do a lot of work in InsurTech, Tony. What's the landscape out there? What kind of ideas are out there getting funded most at the moment? And sometimes these tend to follow fashions. I've followed the sort of InsurTech phenomenon for the last decade. And when you put the word tech into insurance, it does become a bit more kind of, let's say it's more fast moving. People are really chasing around after the latest thing. What kind of things are getting funded at the moment? I'm presuming it's all going to be to do with AI.
I would say that in general, we've been spending a fair amount of time in InsurTech, but we've tried to be extremely careful in trying to evaluate those businesses that we think can succeed versus not. And my guess is, and this isn't backed by any necessarily empirical evidence, but my guess is that 15 to 20% of the InsurTech businesses that are started actually succeed. And for us, it's been a lot about trying to see businesses where you have a very clear path to profitability. It's been trying to see businesses that actually can be broadly utilized by the industry to make it better, whether that's from an expense perspective or an underwriting perspective, and businesses where they truly have something distinctive from a technology perspective. We see a lot of businesses that are data-centric and analytic. Those businesses are interesting to a lot of customers who want to use those analytics and that data. We see, obviously, AI companies, and the recent sale of Cytora to Applied, which we worked on, is a great example of a company that has a special mousetrap as it comes to using AI and processing the insurance process, if you will, and automating the insurance process. And we see businesses where, for example, analytical businesses, you think of a business like CyberCube, which is now the standard for modeling cyber exposure in the context of the ILS market. Those are businesses that we like, and automated MGAs focused on specific perils, et cetera. So those are businesses that we like, but discerning which ones are going to be successful from which aren't is a tricky exercise, and one that we're trying to be very careful about.
And Joe, what's your experience been? Because I'm sure as a prominent industry figure and as a potential angel investor over the last decade, you must have been offered, can you come and help us? And perhaps could you, help us out with the seed capital to get this new idea off the ground? I can imagine, particularly once you'd moved on from Willis, I can imagine this is the sort of thing that people will be phoning you up and offering you a piece of the action here and there all the time. What's your experience been?
That has happened often. I got waylaid with other ventures. And to be honest with you, as I look back, I had opportunities to create entities or to be helpful in creating entities that were not necessarily InsurTech, but had more analytics, more data, and more technology processing, if you will, to the business that I wish I'd taken advantage of, to be honest, Mark. The reason is I always felt that as much of a cheerleader as I was for the industry and what it did for society and what it did in general, because without it, nothing would have happened. By the same token, I didn't think that it had invested enough in technology and in processing. I still thought that the claims part of the business took too long when they could have been using the same technology that we used in the investment business. I think manualization of placing business, it was too manual. I think the whole wording process and getting wordings done took too long, because I experienced that with the World Trade Center. As you know, We bound that insurance in July, but wordings never took place. And I always use the expression, it was the only industry that shook hands and never knew what the hell it shook hands about. It's a fact, because we bound the Trade Center in July of 2001, and then September happened, and that's when all the issues about one occurrence, two occurrences, because the wordings weren't complete. And so I always felt that why shouldn't everything get done properly and bound properly? Why shouldn't all the claims get done and processed quickly? And that the brokers had a big responsibility in doing that. So I had opportunities to not clean all that up, but have an impact on making all the things that I thought should happen and fixed in the insurance industry fixed, but I didn't take advantage of it. So I still think that the responsibility that the insurance industry has, both from a broker side and from an insurance company side, is great, because it's so vital to the epicenter of capital and the epicenter of commerce. But with that, you need to raise your game and be able to place business quickly and to be able to pay claims quickly. People should get paid for the right reason. Brokers should get paid to make sure that the client's best interests are taken care of. And insurance companies have a responsibility to make sure that if they accept the risk, then if it's done under the right circumstances, pay it and pay it quickly.
So it sounds like to me that anybody, an insurtech coming and solving those real fundamental operational problems around claims, around placing, around wordings, around all the back office, it sounds like they'd get a good hearing from you.
I did. I had the opportunity to do that because I said to a few people, this is what I think you should do to solve the problems or make the industry better, because it has a great responsibility to the public. It's one of those industries that has a responsibility to the public. And as a result of that, you have to invest properly to ensure that you can affect those responsibilities properly. And I think that there's still opportunities to be able to do that. That's why one of the reasons that I joined Tony, because I think we can help in that process. We can help companies advise as to what they should be able to do, not only from a banking point of view, Mark. Tony certainly has that background. I have that background back in my investment banking days at Churchill Lehman Brothers, but also I have it as an operator in insurance. So what we'd like to do is to be able to help people get together so that by together, they can do all the things that affect great claims processing, great placement capability, and be able to grow their business and grow clients. And then after the deal is done, not end with a closing dinner as everybody has. We don't believe in closing dinners because that's when the bankers go away and then the people are left with executing what the deal was supposed to do. We want to help them execute, because the hardest part of a transaction is the execution of what the numbers on the page say you should do. And I think we bring that to the table. And that's exciting.
You mentioned right at the beginning about the world becoming more uncertain. Part of that, obviously, geopolitics are particularly interesting at the moment. We've had the imposition of tariffs on trade coming into the US, obviously biggest economy in the world. What's your initial assessment about how that's going to affect business flows in the insurance industry and whether that will create some winners and losers? Have you had any thoughts about that?
Personally, I think it's too early to tell what the impact of tariffs is going to be on inflation. You could take either side of that argument, I think. And therefore, it's too early to tell what impact it's going to have on economic growth, and too early to tell what, if any, impact, from my perspective, it's going to have on the insurance space. At the moment, it doesn't feel like it's particularly disruptive, but I don't think all the unintended consequences of that strategy have played out yet.
Okay, well, that's fair enough. Yeah, and Joe?
I was basically going to say the same thing. The only thing I would add to that is that I'm not sure, after this administration has been in business for 9 months, whether or not the whole tariff situation is strategic or tactical. I'm not sure. And so, as Tony said, it's too early. I don't think there's anybody that can say this is strategic in nature and this is the way this administration is going to operate, or it's tactical in order to get some things they needed to get done, to use tariffs to get them done. I don't know that yet.
time will tell whether it's either one or the other. That's really interesting. Thanks for that insight. Let's just kind of finish off with a fundamental question about, as investors and people who are very close to the investors in our industry, if you're an insurance investor, what would you be buying and holding most? What would be most happy to buy and hold? Well, Joe, you said long term you love a really well capitalized global insurer that's relevant and is incredibly resilient and well diversified and well capitalized, because it will be able to ride through anything and won't worry you too much, one presumes. Any other investment advice you'd be giving? Okay, not specific investment advice, because there's not that kind of program, and I'm not ACC regulated. But yeah, just in general, what kind of businesses would you be buying and holding most happily? Which segments?
I would invest in a company that has a broad line of insurance businesses that is not specifically property, or specifically liability, or specifically specialty, et cetera. I'd buy one that runs the gamut of involvement in all of the various elements of insurance. So that way I understand that I overcome those peaks and valleys, or all the uncertainties and all the vagaries that now occur on a daily basis, that have the right capital around a broad base of insurance capabilities and stay with it over a long period of time, have a strong balance sheet, and is able to withstand all the capacities without having to worry about outside capacity at any point in time. If I find that, and by the way, it can give me a dividend, I'll invest in that.
Tony?
Well, I agree on that. Whether it's in the carrier space or in the distribution space, I would say there are two things I'd be looking for. One is truly best-in-class management team and culture, right? Like, who has it right in terms of the right culture to grow the business, and also who has sufficient scale for and commitment to investing in technology. Because I, again, think you have to almost use your wildest imagination to envision what this industry is going to look like in 5 and 10 years based on the pace of change in technology. So I would want great management team and culture, and an ability, which probably means scale, and a proclivity to make the investments in technology. And then if I thought exclusively about the carrier space, every single carrier has a presentation that says they're disciplined underwriters. It gets back to culture and leadership.
I would also add to that, and I guess this is cultural, whether you're in the insurance space or the broker space, I would ask them what their purpose was. And if their purpose was to ensure that their clients were handled properly, that their clients' risk was mitigated, that their clients, they understood they had a responsibility to the community and the rebuilding of the community, and that was uppermost in their mind. Economics, obviously, notwithstanding, making money notwithstanding, running a business notwithstanding, technology notwithstanding, but is your real purpose and understanding that you play a very vital part in society, whether you're a broker or an insurance company. And if they understood that so that that was their ethos every day, I would invest in that company.
Excellent. Tony and Joe, there are always more questions that would bubble up in my mind or still left on my sheet of different things we could talk about. But I think it's probably going to be taking up too much of your time. So I wonder if there's anything I haven't asked you that you would have liked me to have asked you.
I just want to make the following comment that I am so excited and inspired to be back in business with Joe Plumeri. He is already bringing to us a wealth of experience from a 50-plus year career of running some of the most successful financial services businesses in the world. He obviously turned $300 million into $3.2 billion for KKR at Willis. And he's causing us to think differently and to think bigger. And I'm just thrilled that he's here.
Thank you, Tony. Everybody needs to know that my lure and my excitement of getting back into the insurance business was Tony. Tony and I worked together at Willis. We've been friends ever since that time. And there was always this vision to be back in business together. It's been a couple of weeks. We've done a lot, a couple of weeks. And as you mentioned, Mark, we've had more meetings in a couple of weeks than I think that we intended to have. It's been exciting, and I think we can bring a lot to the table, as I said earlier. And I couldn't be more excited to be back in the insurance business. And I didn't know how much I missed it until my trip to London, and I saw old friends and had conversations like we just had in the last hour. So I couldn't be more thrilled to be back in the insurance business, but especially with Tony, and together, hopefully do some things that really benefit the industry and benefit people.
Well, I couldn't be more thrilled to have both of you on the show. It's been a unique interview. Thank you so much for your time. And let's make sure we do it all again at some point in the future. Thank you so much.
Thanks, Mark. Hope to see you soon. Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.